Hey everyone, welcome back to Corporate Decoder, the place where we dig through the documents that companies don't want you to read. Today, we're diving into Walgreens Boots Alliance, and let's just say their latest report is giving off major Last Days of Rome vibes. Buckle up, it's going to be a bumpy ride. So the big news, Walgreens might be getting bought out. A company called Blazing Star Parent, which is linked to Sycamore Partners, wants to take Walgreens private. Think of it as a real estate developer buying your house with the intention of completely changing it or demolishing it. The report we're looking at is from March of last year and it outlines this proposed deal. Let's get into the specifics. First, we see that Walgreens entered into an agreement and plan of merger with Blazing Star Parent. Basically, they signed the papers to say, okay, we're seriously considering this buyout. Blazing Star will create a subsidiary called Merger Sub, and Merger Sub will merge with Walgreens. Walgreens will continue to exist, but it will be owned by Blazing Star. It's like a corporate identity swap. The joint press release is attached as an exhibit. That's how sure Walgreens was of this buyout. There's also an investor presentation attached as an exhibit. These presentations show how the company is positioning itself. It's designed to get everyone excited about the deal. Now let's talk about some important documents. There's a proxy statement that Walgreens will file with the SEC. A proxy statement on Schedule 14A is filed when a company needs to get shareholder approval for a major action. In this case, it's the buyout. Also, a transaction statement on Schedule 13E3 will be jointly filed. This is the paperwork required when a company is going private. If you own Walgreens stock, these documents are crucial. The company explicitly tells investors to read the proxy statement carefully. It'll have all the details about the buyout, what it means for your shares, and how to vote. You can find these documents on the SEC's website or on Walgreens' Investor Relations page. Here's a heads up, Walgreens directors and executives might be considered participants in this proxy solicitation. What that means is, they're trying to convince you to vote a certain way which makes sense for a company about to be sold. Their information is already in the company's previous filings, including their annual meeting proxy statement from December of the previous year. Now for the part everyone loves, the legal disclaimers. This section is all about forward-looking statements. In simple terms, these are statements about what Walgreens thinks will happen in the future, not guarantees. Walgreens is very careful to say that these forward-looking statements are based on current estimates and assumptions, and they're subject to all sorts of risks and uncertainties. Basically, they're saying, we hope this buyout goes through, but a lot could go wrong. One of the risks they call out is that the deal might not happen at all. Sycamore Partners might not get the financing they need, or regulators might block the deal. There could be other events that cause the deal to fall apart too. Walgreens mentions the financing arrangements that Sycamore Partners needs. This is a critical point. Buyouts of this size require a lot of money. If Sycamore Partners can't borrow enough, the deal is dead. They also note that the buyout depends on getting certain approvals. This includes regulatory approvals like the Federal Trade Commission, as well as getting the thumbs up from Walgreens shareholders. Here's another big one, the deal could be terminated. This means Walgreens might have to pay a fee to Sycamore Partners if the deal fails. The company notes that just announcing the buyout can have a negative effect. It can disrupt Walgreens' plans, make it harder to retain employees, and hurt their relationships with suppliers and customers. It can be hard to keep people on board when there's a big change looming. Employees might worry about their jobs, suppliers might be hesitant to sign long-term contracts, and customers might wonder if the company will change for the worse. Finally, lawsuits. Big deals like this often attract lawsuits. Shareholders might sue, claiming the buyout price is too low. These lawsuits can cost a lot of money and delay the deal. So what's the story here? Walgreens, a household name, is potentially being taken private by a private equity firm. This deal is far from a sure thing. There are many risks, including financing, regulatory approvals, and lawsuits. But now we need to check what this report does not say. The tone of the report is extremely cautious, which suggests some underlying issues. Also, there are no financials. That tells me that the company may not be doing so hot, which in turn suggests that they have something to hide. Now, for my take, I would say I think Walgreens has been struggling. We've seen the rise of online pharmacies and changing consumer habits. Walgreens has been slow to adapt, and the company probably feels they need to shake things up away from public shareholders. But the risks here are real. Private equity firms often load companies up with debt, cut costs aggressively, and then try to sell them for a profit. If this buyout goes through, Walgreens could end up worse off than it is now. My conclusion, be careful. If you own Walgreens stock, read the proxy statement and understand what you're voting for, and keep an eye on this story. It's a big one and it could have a big impact on the future of healthcare. Thanks for watching. If you found this video helpful, please give it a like, leave a comment, and subscribe to Corporate Decoder for more deep dives into the world of business. Until next time.